Within the UK, the Stocks and Shares ISA allows you to deposit £20,000 within a tax year on which you don't have to pay any capital gains tax or any dividend tax, which means all of the profits are for you to keep. So what will happen if you did that for 20 years straight? Hello and welcome guys, it's Millennial Investor here, and today we're gonna have a little fun with Dividend Calculator to see what will happen if you maxed out your Stocks and Shares ISA every single year for 20 years. And now we're gonna go into a couple of examples what would happen if you focus on an S&P 500 or an index fund portfolio. Then we're gonna move on to a more dividend yield focused portfolio, and then we're gonna have an example of what would happen if you actually can't put 20,000 every single year, but you can go much less than that, what kind of variables you have to play with in order to achieve the same returns as with the first two examples. So starting off with our index fund example, the starting principal, it's at £1,000. I know it says dollars, but don't care about that. Annual dividend yield, S&P 500 I believe offers about 1% dividend yield. And when it comes to the taxable account, it is not a taxable account, as we have mentioned. Stocks and Shares ISA, you don't have to pay any tax on when it comes to dividends as well as capital gains. Annual contributions 20,000. Our expected annual dividend increase, I actually don't know that figure when it comes to S&P 500, so we're just going to put it at 1% just to be conservative. Distribution frequency annually, dividend tax rate 0%, because if you invest into an index fund that tracks S&P 500 within the UK, such as Vanguard, you don't have to actually pay any taxes on the dividends. Expected annual share price appreciation. So S&P over the last 40 years has been increasing in the value about 8 to 10% every single year, but we're just going to put it at 7% just to be conservative, so we don't go for the most optimistic scenario, but just put it pretty safely at 7%. Tax exempt dividend income allowed per year, we can put it at whatever value we want because we don't pay any taxes on our dividends. And the years invested is 20 years as already mentioned. So let's look at the charts and see what we have going on. First year, obviously it's 21,000, and then by the end of the 20-year journey we have 933,000 in our account. That's not bad for dumping all of your money into an index fund. Moving on to a more detailed breakdown, each year you can see how everything would be increasing. We can see the cumulative dividends that you would be paid out at the end. It would be close to 75k over the 20-year period, and the annual dividend with 933,000 would be at around $10,000, £10,000. All right, so you would only contribute £400,000 over the 20 years, but your portfolio would be worth 933k, so that's not bad. If we look at the summary right here, the total return is standing at 132%, so that's not the biggest return. Obviously we only appreciate 7% every single year, but that's still not bad. That's much better than any saving accounts you could have. That's still beating the inflation rate in the UK, so it's much better than anything that you could do without putting much effort into it. The annual dividend income would be at 11k, so you can pretty much pay all of your expenses after 20 years with just your dividends from S&P 500, and that's really low dividends. That's only 1% dividend offered by the index fund, and the total dividend payments over the 20 years would be 75k. But it's very important that you reinvest every single dividend payment that you get, especially towards the later years of the 20-year journey, because you will be receiving more and more dividends. So when you reinvest them, you have more money in your portfolio, and then that appreciates in value over time, and you take advantage of the compounding interest. So that was the first example of dumping all of your money into an index fund such as S&P 500 that offers 1% dividend yield and appreciates about 7% per year. Now with the second example, we're gonna focus on a more diverse portfolio that focuses on dividend yields. When it comes to a dividend portfolio, the yield will be standing at about 3%. That's what the companies offer. It will be between 1 and 5% for a more stable company such as a dividend aristocrat like Pepsi, like Coca-Cola, J&J, P&G, Waste Management, what have you. It will be close to 3% with a diverse portfolio that focuses on dividends. So every single principle still stays the same. All we will change is the annual dividend increase to about 5%. I'm actually not sure about this figure. It can be much bigger for some companies, it can be much smaller for other companies, but we'll just leave it at 5% to be quite conservative. And expected annual share increase appreciation, let's go with 5%. So we still are averaging about 8%, but let's see how the figures change and what kind of profits and dividends you can expect at the end of 20 years with maxing out your stocks and shares ISA. And I must say that the results are quite surprising. So with the first year we still got 21k, and at the end of the 20-year journey we have 1.2 million in our portfolio balance. Now that's almost 300,000 more than with the first example. And why is that? That's because you are receiving more and more dividends, and as you reinvest those, the compounding interest kicks in, especially over the last 5 years. You can see that it goes from 600k to 1.2 million in the last 5 years. Now that's the magic and beauty of compounding interest and the dividends being reinvested every single year. So at the end of the 20 years you have 1.2 million pounds. Your total return is 206%, with an average annual return of 10%, and the annual dividend income is standing at 97k, with total dividend payments over the 20 years standing at 450k. So that might be a little bit unrealistic, so let's change the expected annual dividend increase to 3% and see what kind of figures we can get. It is still much bigger. At the end of the 20-year journey we can see that it is at 1.06 million, so about 120k more than the S&P 500 example, and our annual dividend income is 58k, so it's still much better, and we can take those dividend outs every single year without having to pay any tax on it, because it's all in our stocks and shares ISA account, which gives us that tax-free income. So that's really taking advantage of the ISA itself, because at the end of the 20 years you can just live off of your dividends, well, based on what kind of spendings you have, right? That's going to depend person to person, but you can live off of your dividends without having to pay a single penny of tax for it. So that's really important when you focus on the dividends, to make sure you have a tax advantaged account that allows you to take out money without paying any tax on it. So that's a pretty good example of what a dividend portfolio could do over a certain period of time, such as 20 years, and what kind of returns you would be expecting at the end of the journey. But obviously not everyone is going to have 20,000 to put into the investment account every single year. Most people are going to be working on a 15 to 25k contract a year, so all they can afford is maybe 5 to 10k a year into the investment account. So let's see what would happen if you cut the amount invested by half. So we go down to 10,000 pounds invested every single year, but we increase the years invested by just 5. So we go to 25 years invested. We keep all the figures the same when it comes to the dividend example, and let's look at what we have in store for us. So we start with just 11,000 with our first year, but our portfolio at the end of the journey is still worth 960k. So you can see how important it is to keep reinvesting those dividends and take advantage of the compounding interest. And even if you can't invest 20k a year to max out your stocks and shares ISA, you can invest half of that, but as long as you keep it for longer, you will still receive the same results. So that's really important, especially for the younger people, that if you start investing early on, let's say by the age of 20 you already have a decent job, you finished your uni, and you start investing 10k a year into your dividend portfolio. By the age you are 45, you can have 960k pounds, and you can get paid dividends of maybe 40 to 60k, right, depending on the dividend yield that you actually have. So that's an incredible achievement by the age of 45. But if you start investing at 35 and you only have 10k to invest, by the time you are 60 you will have 1 million. So it's really important to start investing early if you have the ability to do so, because you can see that the results are very interesting towards the later years of the portfolio as the compounding kicks in. So you can see on the graph that from year 5 to year 10, your portfolio increases in 90k of value, but that is because you have deposited 50k yourself. But when you look at year 20 to year 25, it increases of about 400k. Now that's the real magic of compound interest. So hopefully with those 3 examples, I have made it a little bit more clear to you why it is important to reinvest your dividends, to take advantage of the compounding interest, as well as the tax advantage accounts such as stocks and shares ISA. And if you have the ability to max it out every single year, why you should do it. So if you guys want to open your own stocks and shares ISA account, there is a link down in the description for a free trade link where you will receive a free stock worth up to £200 for your first deposit of £10. And if you enjoyed the video, make sure to leave a like, subscribe to the channel for the YouTube algorithm, and leave a comment down in the description what you want to see next when it comes to investing or crypto. And I will see you in the next one.